Anyone who's ever stared at a crypto chart knows that feeling, right? It is pure, absolute chaos. One minute you're flying, the next you're diving. Now that wild ride is what pulls so many of us in, but let's be honest, it's also what makes trading so incredibly tough. And in the middle of all that noise, we're all looking for that one special tool, that magic signal that's finally gonna make it all click. And this quote just nails it, doesn't it? When the market has a clear direction, everything feels easier. Your strategies fire cleanly, your reads make sense. But the second that volatility kicks in and the market gets choppy, well, even the best laid plans can just fall to pieces. And that's the exact problem we're going to unpack. So this sends us all on that big quest, right? The hunt for that one single perfect signal. Something that can magically sift through all the random noise and just show us the real moves. We've all been there, searching for that holy grail. But what if the answer isn't what we think it is?
Yeah, that search, it usually follows a pretty familiar and kind of frustrating path. You start with something like moving averages, and they're awesome in a trend, until, of course, the market flips sideways and you just get chopped to bits. So you switch it up. You go for an oscillator, like the RSI, perfect for those choppy markets. But then a monster trend takes off, the RSI is screaming overbought for weeks, and you're stuck on the sidelines while the price just keeps on climbing. It's this endless cycle of finding a tool that only works some of the time.
Okay, so this is where we need a major shift in perspective. What if the problem was never the moving average, or the RSI? What if the real problem was just using the right tool at the absolute wrong time? It's a simple idea, but it's the key to everything. The secret isn't about finding a better tool. It's about understanding the market's context before you even think about picking one.
So how do we get that context? Well, instead of seeing the market as this one single chaotic thing, I want you to start thinking of it as having two completely different moods, or what pros call regimes. Just like a person, the market's personality changes. Sometimes it's really decisive, it knows where it's going, and other times, it's just a messy, indecisive blob. Learning to spot which mood it's in, that is the real game changer.
So what exactly do we mean by a market regime? Think of it as the market's underlying personality at any given moment. Is it in a clear trending mood where everyone seems to agree on the direction, or is it in a choppy, sideways mood, just full of uncertainty and back and forth noise? Answering that question is the first, and honestly, the most important thing you can do.
And here they are, side by side. On one hand, you've got a trending market. You see that clear direction, right? Higher highs, higher lows in an uptrend, or the opposite in a downtrend. The volatility is actually helping the move. But then you have a ranging market where the price is just stuck. It's bouncing around between support and resistance with zero real conviction. These are two totally different playing fields, and they demand totally different strategies.
And listen, this isn't just some trader's gut feeling or a neat little theory. There is a well-documented financial phenomenon called volatility clustering. This quote describes it perfectly. Big moves tend to be followed by more big moves, and quiet periods tend to be followed by more quiet periods. This is the academic proof behind our idea of market moods. It tells us the market's personality actually has a memory.
Okay, so if the market has these different moods, how do we read the room? How do we know what's happening right now? This is where we bring in a tool. But listen, we're not using it as a magic signal. We're going to use the Average Directional Index, or ADX, as our regime filter. Its one and only job is to tell us what kind of mood the market is in. Now, this is absolutely crucial to get right. ADX does not care if the price is going up or down. It has no idea. Its only purpose is to measure the strength of whatever move is happening. A high ADX reading just means there's a ton of conviction. Could be from buyers, could be from sellers. A low ADX means weakness, indecision, and chop. Think of it as a conviction meter, not a compass. And here's your cheat sheet. It's really this simple. When the ADX is hanging out below, say 20 or 25, that's your signal the market is weak and probably stuck in a range. It's a choppy environment. But when ADX starts to climb up past 25, that's the market telling you that a trend is building strength. That zone between 25 and 50, that's where the beautiful, clean trends tend to live. This little table is your diagnostic tool.
And this right here is where it all comes together. This is the whole point. Once you can diagnose the market's mood, you can finally match your strategy to it. You stop trying to force one tool to work in every single condition. Instead, you pick the specialized tool that was literally designed for the environment you're in right now. That, my friends, is the secret to consistency.
So let's put it into practice. Your ADX reading is low, let's say it's below 25.
The market is in that choppy, ranging mood. So what's the playbook? Well, now you pull out the tools that love choppy markets. Oscillators like RSI or stochastics are perfect for spotting overbought and oversold levels inside that range. You can also fade the edges of the range, selling up near resistance, buying down near support, because you're not expecting a big, powerful breakout.
But then, the ADX starts to climb. It pushes past 25, it's rising. The game completely changes. We are now officially in a trending mood. This is when you put away the oscillators and bring out your trend-following tools. Now is the time for strategies like buying the pullbacks to a moving average, or looking for those classic breakout and retest patterns. You stop fighting the chop, and you start flowing with the current.
And you know what's cool? This whole idea isn't just some clever trick for us retail traders. This exact same concept is being used at the highest levels of quantitative finance. The big funds and researchers, they don't just build one model and hope for the best. No way. They build entire systems designed to adapt to whatever state the market is in.
One of the really sophisticated tools they use is something called a hidden Markov model, or HMM. And the core idea behind it is just fascinating. These models are literally built on the assumption that there are hidden states of the market, like a high volatility regime versus a low volatility regime, and they try to figure out which state we're in just by looking at the price. It's the exact same concept of identifying the market's mood, just with a whole lot more math.
So what do they do with that info? They don't build one giant master AI to trade everything. Instead, they train specialist models. They'll have one AI that's an absolute expert in quiet, ranging markets, and a totally separate AI that's an expert in wild, trending markets. And when their system detects the market's mood has changed, it just hands over the controls to the right specialist. This is all the proof you need that adapting your strategy isn't just a neat idea, it's how the pros operate.
So you see, that whole quest for a single, perfect, special signal, it's really a distraction. The real secret, the real insight, is realizing that your first job isn't to predict the future. It's to diagnose the present, diagnose the mood, then match your strategy. By just shifting that first question you ask yourself from what's the market going to do next to what mood is the market in right now, you change your entire approach. You go from guessing to adapting. And in the chaos of crypto, adapting isn't just a small edge, it's everything.